right, welcome to the next edition of our Multifamily Investor Nation webinar series. This webinar is going to be all about loan guarantors, specifically for apartment syndications. And so as you can see there on your screen, we're going to be talking about what is a loan guarantor, the role of the loan guarantor, where to find a loan guarantor, selecting the right loan guarantor for your deal, and then also how to properly compensate a loan guarantor. And so we're going to cover all of these topics today. But before we get started, I wanted to introduce myself. So I'm Dan Handford. I'm your host here today on this webinar. I'm one of the managing partners of a company and a group called passiveinvesting.com. You can see that right here on your screen, passiveinvesting.com. And we are a national multifamily investment firm specifically for passive investors. And so you can go to our website, check out more information about us. You can also click on this current offerings button and see the current offerings we have available. One of the multifamily offerings that we have available right now is called the Hudson Cane Bay. It's out of the Charleston, South Carolina MSA. So if you're interested and you have some money to invest passively right now, go to passiveinvesting.com, check out our current offerings and see if it's something that you might be interested in. As you can see there, we also have our self-storage fund and our real estate debt fund available to you as well. And then, of course, if you want to find out more information about me, you can go to our Meet the Team page. We actually just have recently updated this with some information on here as well. And so you can see here, managing partners, our three managing partners, my information here. You can click on my picture. And when you click on my picture, you can actually find a video here as well as some more information about me. So I won't go into a lot of detail about that. I'll just have you go there and do that as well. And then the last thing I wanted to mention before we get started is about the Multifamily Investor Nation Summit. It's a live 3-day all online event for multifamily investors. You can go to mfinsummit.com to find out more information. You can see there the next event coming up is January 20th. 21st and 22nd of January of 2022. So make sure you go there and check that out. Let's go ahead and get into the topic for today. And the first thing we want to talk about is what exactly is a loan guarantor, right? Because the loan guarantors are going to hopefully be able to help you close deals, right? That way you can close more projects and close more deals. And so what does this loan guarantor do? Now, you might have heard some people say, or people use the term key principal or key sponsor or just sponsor of some sort. And really the role of the loan guarantor is to provide the balance sheet to guarantee the loan for acquiring the asset. So I'll give you a quick example. We actually just recently acquired a property out of Charleston, South Carolina. Matter of fact, we just closed on it last Monday, and it was about an $86 million property. And so in order to close that property, we had to put debt on it, right? And the debt that was actually on that property, let me actually see, I don't have the exact number off the top of my head, but let me pull it up here real quick, and I will tell you what the I'll actually tell you what the actual balance was on the loan so you can actually kind of see what we're talking about here. Let me see. There it is. Just a moment here. So the balance or the loan on this particular property was right at, it was actually an $85.85 million property. So we had right at a $70 million debt on it. A principal balance is what it is. So right about 69, 70 million on that one. So in order for us to close that loan, we have to have somebody on our team or a combined number of people on our team that can sign on the debt for that. And there are two things really kind of three things that you need to have in order to be a loan guarantor on these loans. Number one, you have to have a net worth of the loan balance. So if the loan balance on that property is $69 million, we have to have somebody on our team that has a net worth of at least $69 million all these are ands. When there's those three things that I'm talking about, it's and, right? You have to have all three of these things. So the first thing is you have to have a net worth of the loan balance. Now, the second thing is that this loan guarantor must have at least 10% liquidity at any given time during the whole period of that loan. So the balance is $70 million. 10% of that is $7 million. So there's got to be liquidity. Liquidity, of course, means that anything that you can easily access whether it be stocks, bonds, mutuals, whatever it is that's invested, and you can easily pull that money out and use it if you needed it. It could also include things that are inside of a checking account or savings account or money market. It does not include anything that's tied up in an IRA or 401k or any type of retirement account, because those, of course, have penalties. So they do not use those in order to meet for the liquidity. It must be in some of those liquid assets in order to qualify for liquidity. So again, first thing, net worth of the loan balance. Second is a 10% liquidity of the loan balance. And then the third thing is that they must have experience managing these types of assets, right? Now, you might be thinking to yourself, well, that might be a hard person to find, or maybe a needle in the haystack, right? And I would say that in the beginning it can be challenging, but what you can also do is it doesn't necessarily have to be just one person. So you could actually have multiple people that are combining their net worths and are combining their liquidity and combining their experience to be able to meet with this. So there's lots of different ways to slice it. So you could actually have one person that provides all the net worth, one person that provides all the liquidity, and one person that provides the experience. And you can combine those three people into the loan guarantor piece, right? You can also split it up where, you have, half the net worth from somebody, or from person A, and half the net worth from person B. You combine their net worth to be able to achieve that net worth requirement. So there's different ways to slice this up, but that's what the lenders are requiring is for somebody to be a loan guarantor. Now, and with our group, we are very well capitalized. Our managing partners, including myself, are the ones that actually sign on the debt for these. So we all qualify internally for those requirements. So we don't have to look outside of our group to be able to find somebody to be able to be that loan guarantor for us. So that's one benefit that we have. But I know as you're getting started, you might not have that net worth, liquidity, and experience to be able to sign on the debt. So you're going to have to look somewhere else. And so that kind of the specific role of that loan guarantor that you bring on is to be able to use their balance sheet in order to sign on the debt. That's the primary reason, because you might be able to bring some experience or bring somebody on your team that has experience, but if you can find that guarantor that will be able to do it, that's great. Now, if you're trying to find somebody who has never been a loan guarantor before, but they have the net worth and liquidity, as long as you can find that experience component, you should be fine. Now, what a lot of these loan guarantors will get afraid of is the fact that they're signing on a really large amount of debt. And so the thing that they have to be careful of is that you have to what you have to be careful of is that these are typically non-recourse loans on most of these. Now, if you go with a regional bank for a smaller property or something like that, they're going to usually want some sort of what they call recourse financing or recourse guarantors. However, in these larger assets, they are non-recourse loans, meaning that if you default, they don't usually go after you personally. However, if they find anything that is fraudulent or negligent or anything like that, they could go after you for it, right? And so you do have to be careful of that as a loan guarantor, that you're not just signing on a bunch of loans and you're going to, you're working with a bunch of, subpar operators that might not perform the way you need them to perform, and they can come after you. And if you do default, whether it's non-recourse or not, if there is a default, you could potentially be blacklisted from being able to do any more loans in the future. So you have to be careful with that as well. Now, where do you find these loan guarantors? So I'm going to give you several different ideas of where you can find these loan guarantors, but it is kind of like finding investors. You've got to create a relationship with somebody before they're just going to sign on a loan for you, right? Now, we don't do that ourselves with other groups. We do all of our own loan guarantor work in-house, and we don't sign on anybody else's loans, primarily because we want to make sure we can protect our own brand for our own assets, not be worried about somebody else's property while we're trying to also manage our own. And so we've just chosen internally not to do that. But there's several different places that you can actually find these loan guarantors. And I have one of the things that you can do is go to in-person live events and conferences and ask people if they are willing to do that. A lot of times they'll tell you, hey, I'm a loan sponsor, or I'm a key principal, or I'm a loan guarantor. They can do that kind of stuff. Now, when you meet somebody that says that they can be a loan guarantor for you, realize that you must continue to build rapport and build a relationship with that person. You can't just meet them at a conference and then 6 months later find a property and they drop their signature on a loan document for you. That's not how it works. You've got to be able to stay in contact with that person, stay in contact with that person, and be communicating with them about the different deals that you're working on so that they are ready when it's time. Now, one thing that you should also ask them is, you need to ask them what their net worth is and what their liquidity is, right? And sometimes it might be, excuse me, hard for you in the beginning to ask those types of questions because it's not one of those questions you ask somebody every day. Hey, how much money do you have in the bank account? Hey, how much net worth or how much are you worth, right? And so there's different ways to ask it, and you should write this down as well because one of the things that you can do in the very beginning, instead of asking them, how much are you worth or how much liquidity you have, you can ask them that they're going to know the requirements. And so you can ask them a simple question. You can say, what size deal would you feel comfortable signing on the loan for? And so based on their net worth, they might say, 10 million or 5 million or, 50 million, however much it is, right? Like right now, our group can sign on about a $130 to $140 million property is about the high end that we can get as far as the size of a deal, right? So we know internally what's the size of a deal that we can go after while also keeping our guarantee work inside in-house, if you will. And so when you meet somebody, go and ask them and say, what size of a property would you be willing to do it with, right? You're pretty much asking the same question as to how much you're worth and how much liquidity you have, but they know, right? And a lot of times they'll share with you what their net worth is and their liquidity when you ask that question. But that's something that you can definitely ask them without kind of feeling like you're kind of prying into their personal life, if you will. So that's one place you can find them is finding them at a conference or an event, right? That's one of the best places you can do that because you're going to put that face to the name. You're going to shake somebody's hand. You're going to really be able to create that connection with somebody. Now, you can also do it virtually. So there's events that are happening. We talked about the event that we're doing with our Multifamily Investor Nation. We do it twice a year. We have one coming up in January 2022, the MFIN Summit. If you're interested in that, you can go to mfinsummit.com to find out more details. We do that twice a year. So there's over 800 to 900 people there. We use an app called Hoova, which allows us to be able to allow you to network with people in between the events, but also after up to 6 months after the event. And so you can really find people in there that can be a loan guarantor for you. And so a lot of times you have to just pay to play, right? That event is not that expensive. It's like $197 a ticket, but you can go to that event, network with people, attend some of the sessions. And I can almost guarantee you, if you work on it, you're going to find somebody at that event where they can potentially be a loan guarantor for you. Right. So you have to make sure that, you're going to events, whether it be virtual or in person. And even if you don't go to a conference or something like that in person, go to local meetups, right? Maybe you have somebody in your own network that you think has the net worth and liquidity to be able to sign on for you, and you can go talk to them about this. Now, the biggest thing with selecting, the guarantor, is just kind of going into this next topic of selecting the right loan guarantor for your deal. Well, when you're selecting a loan guarantor, you got to know what their net worth and liquidity is. Because if you go after an asset that's, $25 million and the person that you selected as a guarantor only has the ability to have a net worth of 5 million and liquidity of, $1 million, then you're not going to be able to get that deal done. You're going to have to find with just that person. You're going to have to go find a couple other people or one other person at least to come in and be that loan guarantor alongside that person. And so you want to make sure that you're selecting the right loan guarantor or loan guarantors to be able to acquire the asset that you're actually going after at the time. Now, I'm going to go over this last question here about how to compensate a loan guarantor. And then afterwards, we're going to open it up for some questions and answers. And I know there's a couple of them that have already come in here. So we'll talk about that here in just a moment as well. So this last question is how do you compensate a loan guarantor? There's really two primary ways that you could compensate a loan guarantor that I would recommend. Number one, you give them a slice of the GP equity, right? And so I usually recommend about 10 to 15% of the GP equity if all they're doing is bringing on their balance sheet and signing on the loan. Now, if they bring on some additional things, like maybe they like the deal a lot and they have a network of investors and they want to bring some of their own investors onto the deal with you, well, then of course they might get a little bit more, right? Depending on maybe how much they bring in or how much other responsibilities they're going to do from like asset management or due diligence, or maybe they're going to put up some earnest money deposits. So they might get a little bit more than that 10 or 15%. By giving them 10 to 15% of that GP equity, if all they're doing is bringing on their balance sheet and signing on the loan, right? That would be the first thing that would be recommended. There is about a 10 to 15% equity slice of the GP side, right? And so the second thing is that very similar to where you might have an acquisition fee, you're going to also have a loan guarantor fee that you should model into your underwriting. And that loan guarantor fee could be anywhere between a half a point upwards to about 2 to 3%, depending on the size of the deal. The smaller the deal, probably is going to be the higher loan guarantor percentage, and the lower is going to be the lower amount. And the main reason why you have this here is because that loan guarantor has to maintain that liquidity for the entire hold period, right? So this just helps them kind of maintain that liquidity during that hold period and then compensates them for that, because they can't invest it in these multifamily assets and make a lot of money like we're doing, because they have to maintain that liquidity, and investing in multifamily is an illiquid asset investment. And so you cannot qualify for that money tied up can be qualified for liquidity. And so those are the two primary ways, is giving them a slice of the GP and then giving them a loan guarantor. Now, the slice of the GP would give them to be able to allow them to be able to share in everything that happens in the GP, whether it be any fees associated with it, whether it be acquisition fee, whether it be asset management fees or disposition fees or whatever kind of fees you put in there, they're going to be sharing in that. And then of course they're going to share in the promote on the back end. So on the back end, they're going to get paid for whatever the splits are that you've set up for your syndication that you've put together. And so that's the loan guarantor, folks. And there's a lot of different nuances in here. And if you need to watch it again, we'll send out the recording so you can watch this. But it's definitely an important piece of apartment syndication to have a great loan guarantor at your fingertips. So let me go through some of these questions that have come in, and then we'll wrap it up for today here in just a few minutes. So one of the questions came in from Shazad of, can multiple people aggregate their net worth to add up to the $70 million net worth, or does it have to be one person? It can be multiple people. So it does not have to be just one person. You can have multiple people come together to actually build that net worth to whatever requirement you have. Obviously, that net worth requirement was one that I gave for my example that I was talking about, a deal we closed last week. But if you have a deal that's, a $50 million deal and the debt's, $35 million, you need $35 million worth of net worth from a combined group of people, right? It does not have to just be one person. And the nice thing about this is that it does not apply for that the requirements are not that you have to add up your net worth over time, right? So it's only a requirement for each individual deal. So even though I've signed on a $70 million loan last week, if I want to close on another $70 million loan next week, I can, right? So it resets. Every single deal is different. It's not like it's like combining the net worth where right now, I'm probably sitting at about, I don't know, probably 400 to 500 million worth of debt that I've signed on myself. And so you can just add up those numbers, right? So there's not just, one person that can do just this one loan. Then you got to find somebody else to do the next loan, right? You can use the same person on multiple loans. Do lenders care about the guarantor's other outstanding loans when they calculate the 10% liquidity? No, they do not. So they want to make sure you have 10% liquidity of their loan balance. They do not look at any of the loans that you're looking at. Now, they will look at it to make sure that those loans are still performing. So if there are any non-performing loans, then it might be hard for you to be able to get a loan. Question here from Bill. If I'm a loan guarantor, I realize that I must disclose my financials to the lender, but will my financials also be shared with the sponsor or other parties? No, it does not have to be. So you can submit your documents directly to the lender, and the sponsor, the person that's on that deal, does not have to see any of your financials whatsoever. That'll be between you and the lender, and they do not have to be shared with the sponsor at all. Good question there, Bill. Does the LLC apply for the loan for commercial property? Yes, the LLC will, and it'll be a single purpose entity that you will create to be able to apply for that loan. But you have to have the guarantors that actually are personally guaranteeing the loan, because it is a single purpose entity that is being created to acquire the asset. Let's see, what was the loan guarantor fee percentage? So the guarantor fee percentage can range on the equity side about 10 to 15% as far as getting a piece or a slice of the GP. The actual fee itself is going to be anywhere between about 0.5% upwards to about 3%, just maybe even 4%, depending on the size of the deal. The smaller the deal, the higher the guarantor percentage. The larger the deal, the kind of smaller the loan guarantor percentage as well. Let's see, are guarantors joint and several? I don't really know what the question is there, Stephen. So if you want to re-ask that, I can answer that probably. How does the bank guarantee someone is maintaining the liquidity? They require you as a loan guarantor to submit on a quarterly basis bank statements that actually prove your liquidity. And so you have to be able to prove that on a regular basis. Some of the lenders aren't very sticklers about it. They don't check it on a quarterly basis, but we have some lenders that every quarter they send us a document, fill this out and submit your proof of liquidity requirements every single quarter. So you definitely have to be able to make sure that you can maintain that liquidity. Can you guarantee multiple deals with the same net worth? We kind of already answered that, I think, after you asked that question. So yes, that is correct. And can you explain the difference between the two different ways of making them a 10 to 15% GP versus the 1 to 3% loan guarantee points briefly? So Ryan, it's basically doing both, right? I mean, I recommend doing both because you're going to want to compensate them with the guarantee, the loan guarantee amount, and then also compensate them with the percentage of the GP. Now, I've seen some people give more on the GP percentage and then less on the points, or I've seen some people do neither, right? But you have to, I feel like the best way to compensate a loan guarantor is to give them a slice of the GP entity that's being created to acquire the asset. And then also you're making sure that you can carve out some points for them to be able to get when they close the loan as well. All right, let's see here. Answered that one. What are some watch outs that you or people when vetting and selecting a loan guarantor? So the biggest thing is wanting to make sure that loan guarantor doesn't have any other outstanding defaulting loans, right? Some non-performing loans in their background. Obviously, that's not a good thing. If you're looking for a loan guarantor that has experience, like we'll say Freddie Mac or Fannie Mae, you need to ask for that because Fannie Mae or Freddie Mac do want to see experience with their loan products. And so you will need to ask them, do you have agency experience? And if they don't, they're going to likely have to sign on to some loans with somebody else and maybe not even get compensated for it just to get that experience, right? And so you want to make sure you have somebody who has agency experience if you're going to be using an agency loan. So you want to make sure you look at that. And of course, you're going to want to make sure that they have that net worth and liquidity. And it's kind of hard to prove that. But obviously if they get into a deal and they can't sign off on it, it's going to be kind of hard for them to be able to help you with that. And so if you wanted them to be able to submit you some documents or a letter from their CPA that tells you that they do meet those requirements or certain requirements, and that would be a good one for them to be able to do, a good thing for them to be able to do as well. Let's see, what info can I expect the lender to ask for? Just asset/bank account info or income type info, W-2, tax returns, et cetera. They're going to primarily have you fill out, Bill, and depending on it, the local banks will usually require you to send in a lot more, like your W-2s and tax returns and stuff like that. The larger lenders are typically going to require you to submit a PFS, a personal financial statement, and an SREO, a schedule of real estate owned. You submit those two things along with your liquidity, and then they'll usually ask for your personal tax returns for the last 2 to 3 years as well. But outside of that, unless there's some sort of discrepancy, they don't usually get into too many weeds like a local bank does. I always tell people that it was harder for me to close a loan on a commercial property here locally in town with a local bank that I do a lot of business with than it was one of these lenders, right? And a lot of it has to do with the stability of the assets that they're putting loans on as well. But the lenders can pretty much ask for anything, but they'll also run background checks and financial checks and stuff like that to make sure that they're not giving loans to criminals or anything like that has that in their background. Is the loan guarantor fee calculated off the loan size or purchase price? So I recommend doing it off of either one. So I know that didn't really help you too much, but you can do it off the loan size or the purchase price, whatever you choose to do. The loan guarantor will tell you what they would like it to be based off of. I've seen it done both ways, off the loan size, the debt amount, or off the purchase price. Either one I think is fine because you can always modify the fee, whether it's based on the loan size or the purchase price, if you chose to do it one way versus the other. So however you want to do it, it's fine to do it either way. All right. What happens if they fail the liquidity? Well, they could, according to the loan docs, what they will likely do first is they would put you into some sort of probationary period, depending on the performance of the asset, and want you to get that within the next quarterly check. Or they could also come in and put some more controls on the asset. And then in worst case scenario, if you don't maintain the liquidity, they could also call the note and you'd be forced to sell the asset. So there is that as well. So if you do get into this, make sure that you maintain the liquidity and you don't fail that, right? Because that would be a big issue if that actually happened, right? All right. It means any one guarantor is due for 100% of the debt and not a percentage. Yes, that is correct. It is a joint combined effort. So if for some reason a property defaults and there's 3 guarantors, all 3 of them are responsible for 100% of it, right? Now, what happens is that when a deal goes into default, let's just go back to this deal that I gave you earlier about the asset that I own that we just closed last week. It's a $70 million piece of debt on that property. The property's worth $86 million. Matter of fact, it stabilized at $108 million as property did last week, right? Last Monday, which is great. It's phenomenal for us to be able to acquire that asset at such a great basis. But if for some reason we default on this property, which, I don't think it's going to happen because it's a great property, great location. It's a great deal altogether. But let's say we did, right? We defaulted on it. They don't just come after us and say, hey, Dan, Danny, Brandon, you guys owe us $70 million because that's the balance on the loan, right? They will basically take over the property, sell it. And if there's any difference, let's say they could only sell the property for $65 million, then we would be responsible for the difference, which is that kind of $4 to $5 million gap. Now, that is if they were able to convert it from non-recourse to recourse. Now, with us, that property, it's a non-recourse loan. So they'd have to find some sort of, bad boy carve-outs, if you will, to what they call those, or bad boy carve-outs. They have to find some reason why they could go after us for it because of some sort of fraudulent negligence or something like that, right? And so it's not like you're responsible for the full 70 million, but they want to make sure that you have that net worth. So if something does happen to the property, there's a person in the background that's financially stable enough to be able to help support that asset if it needs it. But even if we are to default on that asset, the chances are us selling it for at least 70 million are pretty high, which again, that's one of the reasons why these lenders allow us to be able to have these non-recourse loans, because they know that even if we do default on the asset, that there's a property there that they can sell and get all, if not most if not all of their money out of the asset at the same time. Okay. All right. I got one last question here, and then we're going to wrap it up for today. This is from Dalton. He says, you may have already answered this, but as someone's trying to gain experience from being a part of GP on deals, do I or other partners need to sign onto the loan with the loan guarantor to ensure the experience is captured? I would say yes. So if you're the main operator and sponsor on a deal, whether you have a lot of net worth or liquidity or experience, you should be signing on the loan as a loan guarantor, because number one, it'll help you build your own net worth and liquidity, but it'll also help you build your experience. So on future deals, you could bring that experience piece of it to the table. And as the main operator, the lenders are going to usually require you to be a loan guarantor as well, because they want to make sure that you are on the hook if something happens, so that you can continue to make sure that you watch over and you perform properly on that asset. All right. Well, hopefully that was a helpful webinar today on loan guarantors for apartment syndication. Thank you so much for being here. Thank you so much for all the questions. Looking forward to seeing you back next week. Let me see if I can refresh the screen and see. Next week is going to be Danny Randazzo, one of our other managing partners there. And he's going to be going over goal setting 101 for real estate investing. So make sure you go and check it out and be at that webinar next week for Danny. He is really good about this particular topic and enjoys talking to people about this as well. So go check it out. And also don't forget, go to mfinsummit.com and register for the next summit. And we'll see you in January 2022. Otherwise, stay tuned for our webinar coming up next week as well. Thank you so much, and hope you have a great rest of your day.